Hey guys, Steven here, aka the Boiler Master. Got another video with some DD on IQST. A lot of guys are asking me to cover today's PR and the filings that went along with it. I'm going to go through it pretty quick because there's a lot to cover. There's some good, some bad, but we'll get into it and how it actually impacts the company. So here's the PR. CEO highlights progress since QXTEL acquisition announcement. Goes on to say, basically, $250 million company. They publish their pro forma sheet. It says the teams have already made progress on streamlining operations and taking advantage of our respective customer synergies. So the two teams are already working together. They haven't officially closed the acquisition yet, but they're working together, cross-selling already. That's really good to see. The extraordinary month of January is now on IQSTEL's record books with $17 million in revenue before the execution of QXTEL purchase agreement. The QXTEL management team and the IQSTEL management team are acting as one with the combined management of each meeting weekly to review and coordinate sales operations. So again, they're already working together cross-selling. I am delighted by how well the two management teams have come together and convinced more now than ever that the combined whole is greater than the sum of its parts. We have already identified new business opportunities that separately would not have been possible. In addition to the previous disclosures already published in conjunction with the QXTEL acquisition, we are publishing an S-1 registration statement in accordance with the terms of the bridge financing agreement funding the QXTEL acquisition. So that's the S-1 I mentioned. If you don't know what an S-1 is, it's something you file with the SEC to register shares to be sold. It goes on to say the bridge financing is a loan secured by a 12-month convertible note. As suggested by the term bridge, the loan is intended to serve as a temporary vehicle while IQSTEL works to secure more comprehensive strategic financing that will both pay off the bridge loan and fund further strategic growth. The S-1 registration statement also includes a separate stock option intended to fund additional potential acquisitions under IQSTEL's ongoing M&A campaign in 2024. Standing on IQSTEL's tremendous results for January, the 2024 horizon for IQSTEL truly looks to be heading toward the best year ever. A couple things I really want to emphasize here. Number one, bridge loan. All right. So I've been saying that for, weeks now, that this M2B funding, this convertible note, it's nothing more than a bridge loan. They told us they want to use the bond sale to LDA to pay for the QXTEL acquisition, but they could not close it in time, and they had to move forward and sign the agreement and make the deposit. So they reached out to M2B and got funding from them. It's temporary funding. That's what a bridge loan is. It's temporary funding until you get something longer term in place. I've been trying to tell people that everything indicates that. They're confirming they're still working with LDA. It is a bridge loan. And I'm going to say, I think Leo's watching my videos because he actually put the term bridge in quotes in here to emphasize this is a bridge loan. It even says here that more strategic financing that will both pay off the bridge loan and fund further strategic growth. All right. So we're going to circle back to why that's so important when we get down into how all this impacts the actual company and the value of the company. So moving on, the thing that really freaked everybody out and caused the major drop today, if you guys were watching, stock was up. I think it touched 32.5 going towards 33 cents long-term resistance. And then pretty quick, it started to crash. It bottomed. I think it touched 22 cents today. So yeah, a bit of a freak out in the market. But if we look at the S1, you can see why. There was a lot of fear. A lot of people were putting a lot of bad information out on the message boards and scaring everybody on worst case scenarios. But here it is. The S1 is registering shares that can potentially be sold. So 32 million shares in the S1 are available to be sold. You guys can read this. It says that an aggregate of 32.2 million shares of common stock, including 2 million shares of common stock, 20 million shares of common stock issuable upon conversion of a secured convertible promissory note, and 10 million shares of common stock issuable upon exercise of a common stock purchase option. So 32 million and 20 million of them are issuable upon conversion of the convertible note. Now, the convertible note, they just told us, is a bridge loan that they intend to pay off. And they have told us already that the intent of it is just financing and they plan to pay it off. It's not going to convert. That's in there in the event that they were to default on payments, but they have a plan to pay it off. So they have to keep shares available in the event they were to default. They're required to, per the agreement. That's part of the loan. They're borrowed money. They have to have shares available in case they defaulted. That's what backs the loan, but they have a plan to pay the loan. So that 20 million shares is not going to be issued unless they default on the loan, and they're not going to. So this is a formality just to make 20 million shares available. The 10 million shares is part of the options agreement. So we have to look at the options agreement. We've already covered the convertible note. If you guys don't know much about that, watch my other video. I walked through all the details of that, what it's costing the company, and how I expect that to play out. And I went through the details in the filing, at least some of them. You guys should read the full filings yourself. But if we get into the options agreement, the 10 million shares, that's what we're concerned about. Here's the agreement. I'll pull it up. You guys pause the video, read this section if you want, but again, read the entire filing. I'm going to give you guys the bullet points of this options agreement. All right. Signed and dated February 12th, 2024. It expires at the end of the year, December 31st, 2024. It is for 10 million shares. The exercise price is 70% of the VWAP, which is volume weighted average price. So they're getting a 30% discount. We'll get more into that. And it does say that they will exercise no less than $2 million of the common stock no later than March 31st. Further down in the options agreement and the filings, it walks you through exercise price. You guys pause it, read this if you want. But again, it's a 30% discount from the VWAP. VWAP, volume weighted average price, just basically all the shares traded, the price they traded at, it gets the average there, and they can exercise at a 30% discount from that price. So if we're 30 cents a share is the average VWAP, 30% off that, they would be buying shares at 21 cents, 30% discount. All right. I've highlighted a section here. I'm just going to read it and I'll walk through it. Okay. So word for word, holder has the right and the obligation, pay attention to the word obligation, to exercise on a cash basis not less than 2 million of the option shares not later than the later of March 31st, 2024, or the date on which there is an effective registration statement permitting the issuance of the option shares to or resale of the option shares by the holder. From and after the occurrence of the above reference exercise, each additional exercise of options hereunder shall be in an amount not less than 1 million shares, which shall occur every 30 days and shall be exercised only on a cash basis. The holder's obligation to exercise each specified portion of this option on the specific date set forth in this Section 2A is subject to the exercise price being not less than 11 cents per share. So in other words, they have the right, but they also have the obligation. They are obligated to buy these shares. So IQST did just give them an option and say, hey, do you want to buy some shares? This is an agreement. They have to buy some. So 2 million shares before March 31st, 1 million shares every 30 days after that until there's 10 million shares. So it should be 8 months past that. Every month they're going to buy another 1 million shares. So what does that actually look like for us? Well, current share price closed today was just over 23 cents. So we don't know what the VWAP will be when they exercise 2 million. They could do it tomorrow. They could wait until March 31st. But right now, today, 30% discount from that would be 16.324 cents per share. So 2 million shares at that price would raise $326,480. $1 million per month after that. Again, we don't know what the VWAP will be, but at the same price, getting them for about 16 cents a share, it would be $163,240 a month. Do that for 8 months, you're at $1.3 million. So keep in mind they paid $100,000 up front for this option. So if you look at the $2 million they're going to buy, 8 monthly purchases of $1 million, we're looking at total cash raised of $1.7 million raised for the 10 million shares issued. That's what the option is going to do. It's going to sell 10 million shares. It's going to raise somewhere around $1.7 million if the stock was stayed at today's closing price and didn't change. If it goes down, they'll raise a little bit less cash from it, but if it goes up, they'll raise a little bit more cash from it. But the 10 million shares will stay the same. So a couple things to point out here. People were saying online they're buying at 11 cents. We're diluting at 11. That's not the case. 11 cents is the absolute bottom. It can't go any lower than that. They can't buy shares lower than that. And if it goes lower than that, they don't have to exercise. Another thing, everybody's comparing this to Apollo. Apollo option was bad because the Apollo options was structured on a dollar amount. They were trying to raise $4.8 million. If the share price went down, Apollo would buy more shares and they could still raise the same amount of cash. If the share price went up, Apollo would buy less shares and still raise the same amount of cash. This option is structured the opposite. It's based on shares. They can buy 10 million shares, and if the share price goes down, it's just less capital raised. If the share price goes up, it's more capital raised, but it stays at 10 million shares regardless. So people saying that it's just a repeat of Apollo, it is absolutely not. Worst case scenario with Apollo at bare minimum price, the entire options agreement, max pain would have been 48 million share dilution. That can't happen here. This is just for 10 million shares, period. So we know exactly what the dilution is going to be from it, and we have a ballpark idea how much cash is going to be raised from it. There's no fear and uncertainty and what ifs, and we're not begging and waiting for it to expire and not knowing what's going to happen. We know it's 10 million shares, and we can build that in right now and know exactly what the effect is. So let's just do that. So if you guys watch my other DD videos, I completely walk through the entire purchase agreement with Yukon Rivers to purchase IQST and all the financing terms there, how much potential dilution there may be. And you guys see this chart that potentially we were looking at worst case about 15 million shares dilution. That is that the convertible note gets paid off. There's a few shares associated with that, but not enough to really matter. The big thing is whether or not the seller of IQST accepts the remaining $2 million in payment as cash, or if he accepts it in the form of IQST shares, which will have a restriction on them that he cannot resell on the market without calling IQST first and giving them first right of refusal. So all that aside, go back, watch that video if you need to. What we looked at, it looked like there was going to be, worst case, about 15 million share dilution. Again, if he takes a payment of shares, it's based on VWAP with a 20% discount, so we don't know how many shares it would be, but we were estimating that seller would get somewhere between 8 and 12 million, and the convertible note has some that was paid up front that was a couple million. So adding 15 million shares, we were looking at 2024 year doing 300 million revenue, ending the year with about 188 million shares, and we would be looking at revenue per share going up to $1.59. That's a 94% increase in revenue per share. So that amount of dilution is extremely offset by the year-over-year growth. That's what we're estimating. That was kind of our worst case projection. Now, if we stay with kind of the worst case projection and add 10 million more shares to it, we're looking at 198.3 million shares with 300 million revenue. That puts our revenue per share at $1.51. So year over year revenue per share growth would still be up 84%. So worst case scenario, selling to Yukon, he wants shares instead of 2 million cash. We're at $1.59 revenue per share. If the options agreement is 10 million shares and the Yukon River Holdings, once their last payment of shares as well, worst case, we end up at 198 million shares. Based on 300 million revenue, we still go up 84% year over year. So 94% year over year, 84% year over year. It still goes up 84%. The growth from this is far offsetting any effects of dilution. It's not even a question. It's math. It's worth it. So to emphasize that, let's look back at where we were at the end of 2023. We finished the year with 171.5 million shares. Everybody was kind of on the same page, doing 140 million revenue. We were projecting, they might do about 200 million revenue this year. So given that scenario, if they did that, if they had that level of growth, which was about 44% year over year growth, kind of where they've been, 200 million revenue, 171.5 million shares, revenue per share for 2024 would only be $1.17. Revenue per share would go up 43%. So that's the scenario you've got to look at. No dilution this year, no acquisitions this year, and they grow revenue per share 43%. 25 million dilution, and they make acquisitions, we go up to at least $1.51 revenue per share. So what's better? Do you guys want no dilution and a 43% increase in revenue per share, or a little bit of dilution and an 84% increase in revenue per share? Personally, I'll take the dilution. That is the entire point of a company going public, is to raise capital. You don't take your company public and have to deal with filings and staying compliant with everything and spending all that time and money being a public company unless you're doing it for the ability to raise capital. That's the whole point. Every company out there raises capital. There's dilution. The question is, are they using the dilution well to increase value for shareholders? And that's what these charts tell you. They could do 43% increase in revenue per share this year, or they could do 94% increase in revenue per share this year. It's that simple, guys. I talked about this in another one of my videos, and I'll bring it up again, that everybody freaked out over the Apollo options deal last year, which was significantly worse, but they grew revenue 50% last year, and dilution was only, 6%? So last year we saw 6% dilution and a 50% increase in revenue, so revenue per share grew 42%. Everyone freaked out about the Apollo deal, and a year later, we were in a significantly better position owning the company. It's worth more. And now everybody's starting to freak out over this options deal, and a year from now, we're going to be in a significantly better position than we are today. They are adding a serious amount of value to the company. So let's get into some of the concerns. I know a big one is the 11-cent share price. People are freaking out. They're comparing that to Apollo too and saying this is even a worse deal because it's 11. Apollo's minimum was 13.6. It's not a worse deal. It's basically the same deal. So where did those numbers come from? How did they come up with those minimums? Well, Apollo had a better deal because they didn't get a 30% discount. They got a 32% discount. So we're slightly better on the discount. Where they came up with the minimums was that at the time the Apollo options agreement was signed, the share price was around 40 cents. It was 40, 42. It was sitting in that range. They made an agreement with Apollo, and the minimum purchase price was going to be 20-cent share price. Take their 32% discount from that, so their minimum buy price was 13.6 cents. Share price of half of what it currently was going to be the minimum, 20 cents with their discount. Now, here we are signing a deal with API, and the current share price is around 30 cents. You take half of that, you're about 15, and you add a 30% discount that they get, and the minimum buy price comes in around 11. So it's basically the same deal, that your discount will be applied, and the minimum we're going to apply to is half the current share price at the time of signing the deal. It's structured basically the same. So it's not a better deal. They're only getting a 30% discount, not a 32% discount, and it can't be nearly as much dilution as Apollo had. Apollo could go up to 48 million shares, and we're all happy that expired. API will buy exactly 10 million shares. They can't buy any more than that. So this is significantly better. Now, I'll be honest with you, I didn't want to see another options agreement. I expressed my opinions to the company about the previous one. I was happy to see it expire. I never thought they would do another one. But here we are signing another one. I wasn't overly happy about it. I expressed my opinions to Brad. My concerns is not how this affects the company and the value of the company. I just knew how investors were going to react. Everyone hated Apollo. Everyone immediately thought, oh, great, more of that. So this is not that. This is significantly better. It's not going to hurt us nearly as bad. Overall, this is going to be perfectly fine. And they're going to use the money for more acquisitions. We're going to come out of this way better off. But it hurt sentiment. We were finally in a nice uptrend. Everybody was positive. Everybody was happy about the stock and optimistic about where it was going. And I could have told them before they released this PR that is going to crash if you release that PR. It doesn't matter if it's good for the company or not. Nobody wants to hear the word options agreement, period. Didn't matter what was in it. And filing an S1 that says 32 million shares just scared everybody. And not to mention the bears and the shorts and anybody that can profit from the stock going down naturally screams, the world is falling. 32 million shares will be sold at 11 cents, whether it's true or not. Hell, it got stock to drop 30%. So how much money did they make off of that? It is what it is. The other things that are being talked about on boards, in fact, I talked to my buddy Snyder. I told him I'd just go ahead and bring this up. He gave me permission. So let me just read Snyder's post here, and I want to answer a couple of his questions. So I told him I was going to make a video and address some of this. He said, please do. I have said it before, but I am not too good with filings. I'm damn close to selling my position and moving on. They dangle a carrot consistently. I didn't like the Apollo deal, but I said it's not that bad. I didn't like the M2B deal, but I said it's not too bad. And I don't like this option deal. Every time they add growth and move in the right direction, they seem to make a shitty deal. I can't even keep track of how many shares they are adding. And they make these deals with these little ass fly-by-night institutions that just consistently dump at the bid to make their profit and move on. Why not have a lockup period? There is a reason that the share price is stuck and is so hard to move. It's because of shit like this. Then they want shareholders to get the word out. Why? So they can just fuck over new investors. Okay, when I shared that, I didn't realize just how bad the language was, so I apologize for that. I know I cuss too much as it is, but that's on me. Maybe I'll re-record this. First of all, shitty deals. Well, I just talked about it. The Apollo deal was horrible. I will agree with that 100%. It frustrated me. I didn't like that deal. But again, I knew we were going to come out of it and everything was going to be all right because of the level of growth and it's behind us. This one's not nearly as bad. The convertible note they've confirmed it's just a bridge loan. It's not going to convert unless something catastrophic happens with the company. They've got 12 months to get it paid off and they have plans in place. So even if those plans fall through, they got 12 months to figure out some backup plans. I don't anticipate anything going on there. And again, they had to. They had to move forward. They had to close this deal, sign the agreement, and make the deposit for the QXTEL acquisition. It's a company doing $80 million a year in revenue. It seems like the perfect merger to me, and they couldn't let that get away. I don't know why. I don't know if somebody else was interested and potentially going to make an offer, but they had to move forward, and they moved forward with the options they had. So, and just a reminder, with the Apollo deal that year, revenue per share still increased 42%. The dilution was only 6% from it. So it is what it is. I got to say, Snyder, you can't even keep track of how many shares they have now. I'm a little bit insulted there. I have charts for this. So you can see that year over year, 2021 dilution was 25%, 2022 it was 10%, 2023 it was 6%. So this year, absolute worst case scenario, if they do 25 million shares, we're talking about 14% dilution. Now, if they do 300 million revenue, that I personally believe is on the low end, that's 114% growth. So we're talking 114% increase in revenue, a 14.6% increase in shares. I can definitely live with that because, like I said, the year-over-year increase on revenue per share is 84 and 94%. So it's still added value for shareholders. Now, would I like to see them sell the bond to LDA and not make deals like this? Absolutely. A non-dilutive bond sale is a significantly better financing deal than a convertible note temporarily and an options agreement, but they're working on it. They're doing what they can. If these guys were on the NASDAQ, they would have better financing terms. They'd have people lined up. They'd have this $60 million bank deal they had lined up, contingent upon listing to the NASDAQ. But they're not. They're stuck on the OTC. But somehow, being an OTC company with limited financing, they're still making acquisitions like IQST doing $80 million a year. So I'm not a huge fan of the financing terms either, but they're really kicking ass with it, considering what they're dealing with. They're doing a pretty darn good job. It is what it is, man. Until they get to NASDAQ, we may see more deals like this, but they're adding value that offsets it, and it turns out to be pretty good for shareholders. So right now we're at, I believe, 175 million shares. And, I walked through the potentials of what we might see and the effects there. So, why not have a lockup period? So you can't have a lockup period. That defeats the purpose. So these S1s, the options agreements, they're selling shares in this way because that's what bigger companies do. A NASDAQ company would sell shares in this way. Previously, before the Apollo deal, they were selling shares by filing a Reg A. They would file, make the shares available, and then sell them on the open market themselves. So the company selling their own shares directly on the open market, they had full control over it. They got market share price over it. But filing an S1 and selling shares to an investment firm and allowing them to do it for you is a more professional way to do it. It's more in line with what NASDAQ companies do. They're doing everything they can to align with what they need to be when they're on NASDAQ. They meet all the requirements except for the share price. That's why they do things like S1s instead of the Reg As. So the entire intent of these shares being bought is to resell them. They're getting them at a discount so they can sell them for the company so the company doesn't sell on the open market themselves. They don't have investors lined up yet saying, yes, I want to buy 10 million shares directly from you and I want to hold them for years. We're going to get there eventually. We're not there today. So when you're raising funding and you just need the capital and you need to sell shares and you don't want to sell them on the open market yourself with a Reg A, you sell them to one of these investment firms that will do it for you and they get them at a discount. So that's why there's no lockup period. It is literally the intent for these investment firms to sell the shares on the open market. So then you ask, did they learn their lesson from Apollo? It's tough, man. I want to say yes, they learned their lesson because this options agreement is structured entirely different. I'm really happy with how they structured the agreement. I'm really disappointed that they went with an options agreement. I feel like there could have been a better way to find the funding than an option agreement. It's like I said, it's not the terms of the agreement, it's the sentiment. Number one, I knew it was going to bother investors, and number two was the timing. I can't tell you why they did it right now. I'm really, really hoping that they come out with another press release in the next couple of days. They've got some extra funding, and I hope that they do something with it, that we had to do it because we needed the cash, because we needed to take this step. Maybe they close the IQST acquisition, Thursday or Friday this week, and that explains why they had to do it, is they just needed some extra funds. I don't know. Maybe they announce on Monday that they've closed the second acquisition they're going after this year. I don't know. But if there's not a reason of why they needed this and why they need the funds right now, this was just a really bad time for that announcement. I really wish that they would have held off, officially close the QXTEL acquisition, get that revenue on the balance sheet, allow the share price to recover at least something reasonable, and build some support up there, and then make an announcement like this. But it's I don't know why they did it today, man. Hopefully we get an answer soon. But like I said, I do believe they learned their lesson from the Apollo deal, because clearly we're not going to get 48 million share dilution this time around, which we didn't get last time either, but that was kind of a worst case scenario. So I want to go back to the PR. We've gone through all of that. You guys see that it's 10 million shares. It's not the end of the world. That's like 6% dilution. It's nothing. When you're going to grow 114% this year, on the low end, we think 6% is not enough to matter. But if we get back into the PR, man, there's some really, really good news in here. They reiterated to us that they're already cross-selling. Number one, that is great. The sooner they're cross-selling, the more revenue they're going to show this year. And number two, it emphasizes that everything's going well with the closing of the acquisition. So we should be seeing that in the near future. The 17 million for January, man, 17 million would be in January would be 51 million a month. It would be 204 million a year. That's before anything from QXTEL, and that is really good. And they also reiterated to us that the intention of the funds is for additional potential acquisitions for their 2024 campaign. They told us that they have a second acquisition that they anticipate closing the first 6 months of this year, and they're reiterating here that the intention of these funds is a potential acquisition for their 2024 campaign. So we know for a fact that they are continuing and pursuing another acquisition. And you guys can see from the deal with QXTEL that the funding they had in place, and that deal, the benefit it brings is really, really good. So no matter what we think about this options agreement, it's one of those scenarios where we don't know what they're going to do with the funds yet, but they're telling us it's for an acquisition that could be really, really, really beneficial to shareholders. They're yet to make an acquisition that I didn't like. They're yet to buy a company that I didn't look at the value of what they paid or any shares that were issued and say, wow, that was a bad deal. If they were working on an acquisition that was not worth diluting 10 million shares, they wouldn't make the acquisition. So all in all, I'm bullish over the scenario. I know it hurts sentiment. I know some investors freaked out. I wish they hadn't announced it right now. I wish they had gone with a different financing option other than the options agreement. But what's done is done. Having read the agreement, knowing what's in it, knowing what they're going to do with the funds, overall, I'm happy. It's bullish PR to me. It hurt the share price this week, but I wasn't going to sell anything this week anyway, so I don't really care. It can continue to go down this week or whatever. It's irrelevant to me. I'm looking at the company's value. When's the company going to go to the NASDAQ? And if anything, this is going to help them get there. My timeline's 2024, 2025. This is going to help them pull that off. What they do today and the little sentiment over this isn't going to hurt anything. And the long-term effect from the dilution is going to be offset, and it's going to end up being value added. So a year from now, we're going to be in a better position than we are today. And that's my goal. So I'm happy. I hope that I shed some light on a little bit of this for you guys. I do urge you to go and read the filings yourself. There's a lot more detail in them, but they're about 100 pages worth of reading, and a lot of it's legal jargon. So my bullet points, consider it my own personal opinions, because I'm not a financial advisor, and I'm human. I do make mistakes. So appreciate it. Hope you guys enjoy the video. Leave some comments to let me know if I skipped anything or if there's anything else I might be able to help add some clarification on. Otherwise, I'll see you guys on the message boards and in the ambassadors group. Thanks.